All right, hi, evening, everyone. Evening. Okay, now, thank you for joining me. All right, on such short notice because we just realized that today we have a clash of events. So we have to bring forward this session over here that we have dedicated over the month of June to educate investors about options trading and the great stuff that you could do with options as an investment tool. Okay, now, so once again, if you're joining us right now, feel free to leave a comment and say hi, all right, so we know who's joining us in our sessions over here this evening so far. All right, so we'll take some time over here while we wait for more people to join us in this evening session. We have an earlier start than normal over here, so apologies for the late notice. All right, we just realized it was today that we have a clash of events. All right, so we do have another event starting at 9 p.m. Where I'll be speaking to a group of investors, all right, who are going to take the next step over here into their option selling portfolio building process. All right, hi Jackie. All right, hi Jackie. Okay, now, so if you've just joined us over here, all right, do drop a note, say hi, so I know who's joining us, all right, for this evening session. Okay, we just wait for a couple more minutes for more people to stream in over here on the late notice that we've sent out via our Telegram app, as well as the Facebook post itself. And then we'll get today's sessions going officially. Hi, Kane. Okay, today is going to be a very, very interesting strategy. Okay, so it's something that I played around with for a little while over here. So for those of you who have, traded stocks based on an indication or, for example, on technical analysis over here, you might find today's strategy discussion very, very useful. Okay. So today we are moving back towards option strategies, okay, to wrap things up over here. Hey, hi Maureen, hi Hockley. All right, great. So I'm going to get the session started officially for today. So if you're just joining us over here, do us the same old drill over here. Click the share button, right? Share it out, share the video out, so we are able to reach out to more people and benefit more people in the process of Project Options cash flow. Okay. Now, so I'll start things off over here with today's stock lingo for today in our Telegram channel. So today we discussed the idea of delisting. All right, so delisting is basically a process where a particular stock over here, which is traded in the stock market, for whatever reasons, maybe has decided to go private or decided to declare bankruptcy over here. So once everything is completed, all right, they will be delisted from the stock market, which means they will take themselves off the stock market, and you can't see them or you can't trade them anymore after that. Okay, so that's a simple term of delisting over here. Okay, so let me share my screen and get the session started and going. Okay, so once again, thank you very much for joining I'm Possible Investors. Sorry, give me a minute. I'm Possible Investors Community Outreach. All right, we're trying to educate as many investors as possible over the month of June 2020 over here, right, with options as an investment tool, right? So we've coined the project over here, Project Options Cash Flow. So continue to share it with any of your friends who have always been looking to invest their money and grow their money over here. All right, it doesn't mean the challenge is over; they can't get access to it. They can always go over to our website, impossibleinvestors.com, right, and then opt themselves in for Project Options Cash Flow, where they will be sent day by day the entire 30 days of the challenge itself once again. Okay, now, so disclaimer before I start the session proper, right? Anything that I discussed today, any trade ideas, okay, it's purely for educational purposes and example highlighting. Right, so if you do decide to act on any of them, please seek your own advice before doing so. All right, let's get going. So today I'm going to the next segment over here, which I call the I'm Possible Option Booster series. Okay, so I'm going to discuss a couple of strategies that I personally use over here on the back. Okay, when planning my portfolios and when I see the right opportunities come onto the table. Okay, so today we are talking about the upseller option trade. Now, so what do we mean by the upseller option trade? So day 25, we're going to discuss this strategy, and as usual, we'll talk about the objectives, how to use this strategy, the pros and cons, choosing the strikes as well as the expiry. Okay, and we'll go and look at some trades over here which we can apply it on. Okay, hi Anthony. Okay, now, so quiz time. Okay, quiz time. Okay, for those of you who are joining us right now, okay, do look at the quiz. So if you see the chart that I'm showing you right now, which shows you Dell Technologies, okay, so Dell Technologies right now, what you see is actually the chart as of today, which means yesterday's closing is the very last bar you see on the chart. So what you have noticed over here is, you know, if you're a technician, all right, you would see that Dell Technologies over here has decided to gap up, all right, and it is the second gap up over here over a span of 1 month. All right, so there must be something going for this company over here, and you know, both times over here on the chart, you can see that the gap up was done on large volumes as well. All right, now why is it important to, you know, make sure that there's large volume whenever there is a gap up? That means, right, that the gap up is being chased up to over here. That means there's conviction over here in the buyers who wants to push the share price up. Now, so today we get the first day. Right, the day after the gap up over here. So let's say, you know, you see a gap up and you really want to start playing this, you know, up move over here or upswing over here. Right, what are some ideas that you can do? Right, so what are some of the option trades you could do over here, right, in order to gain profits? Okay, so this is basically the quiz, right? So how would you trade this opportunity? Okay, so if you're seeing the chart right now, you're seeing Dell over here right now. Okay, now I want you to leave a comment and tell me, how would you trade this opportunity over here? Okay, how would you trade this opportunity? Okay, leave it in the comments. Okay, let's have some ideas over here before I share with you what's the strategy that you can think of and consider it today. Okay. All right, we are also coming towards the end of the, you know, series itself. So I see most of you who are, you know, either community members or the public in general, all right, have been with us for the last 30 days, you know, throughout. Okay, so this will be a good time to actually test you on your knowledge of, you know, what strategies do you think, all right, would be applicable over here, all right, if you're trying to trade this opportunity on the upside, all right, after seeing what has happened to Dell over here on the charts. Okay. All right, so Kane says sell out the money calls. All right, so we have a look at that. Maybe have a look at that. Okay. All right, how about the others? How about the others? Okay, I'm gonna wait for a couple more suggestions over here before I get things moving. All right, call spreads. ID. All right, ID says call spreads. ID, could you elaborate a little bit further? That means, are you thinking of buying the call spread or are you thinking of selling the call spread? Okay. Okay, so ID, it would be great if you can tell us over here, all right, in terms of your call spread that you have left, as a comment over here, are you looking to buy it or are you actually looking to sell it? Yeah. Okay, all right, now how about the others? All right, the others who are joining us right now. Okay, leave a comment over here. Let us know. All right, what are your thoughts? What strategies do you have in mind if you're looking at an opportunity like this? Okay, all right. Shiva, buy puts. All right, buy puts. Interesting. First question over here. All right, first question over here. Why does it seem that, you know, most of you or all of you right now are seemingly bearish, right? You're seemingly bearish on, you know, this breakout over here, all right? Okay, now you need to understand one thing, all right? That means from a very commonsensical, logical form of explanation, right? Let me get my drawing pen back up. What we have over here was this resistance point, right? And very clearly with the gap, all right, what we have is a surge upwards. So if you have a surge upwards over here, all right, so ID over here says sell bear call spread. Now, so ID, so everyone seems to be banking on the fact that, hey, this stock may actually reverse, right? Which is actually contrary, because right now it seems that the strength on this particular stock, all right, is actually on the upside, right? Because we have a breakout over here, which means a sudden move has happened in the market, right? And any short sellers, if they are over here, right, are probably caught blindsided, right? And now they're thinking about, oh, I have a support level over here, I have a support level over here, I have a support level from the last breakout over here, right? And now we're charging forward to, kind of like a new high as well, right? Over the last couple of months after COVID, before and after COVID has started, right? So this will actually kill all the traders over here with, any bearish thoughts as well. So we're probably going to head towards the bullish kind of directional trades. So if you realize we're going to go into bullish trades over here, right? Some of the strategies that you could adopt over here would be things like buying calls, okay, or buying, call spreads, okay, or selling puts, okay, or selling put spreads. Okay, now, so what are the difference over here? If you buy a call spread, you are going to expect to pay, right, to make this money, right? If you buy a call spread over here, you're still expected to pay, right, to make this money, but all you get over here is you get to pay less, right, to make this money over here, right? But at the same time, all right, you will also end up possibly making less, right, because you're capping your profits in this scenario, right? For selling puts over here, right, what you're doing over here is you're trying to get paid, okay, to make this profit over here. And then when you sell put spreads, you're trying to get paid as well, okay, with what we call the limited, all right, loss scenario. Okay, right now, so these are 4 possible trades that you could look at over here, right? But today we're going to do something more interesting. All right, today what we're going to do over here is we're going to structure a trade over here that allows us, right, to capitalize over here, right, by paying and paying less, right? But at the same time, while we pay less over here, we want to substantially increase our profitability, or we can say also the ROI potential on the entire trade itself. Okay, now, so today I'm going to discuss about this right now. One of the ideas over here is this, the upseller on the upside. Okay, so what do you do? Okay, what you do over here is this. You simply combine 2 strategies, okay, 2 approaches over here, which are both bullish on the stock, which means, right, you go out there and first you do what we call a sell put spread. Okay, now why do we say a sell put spread? Right, first because as highlighted over here, right, a sell put spread simply means you get paid, right, when the stock continues to go up or if it stays up. Okay, and it also comes with what we call a limited loss scenario. Okay, so that's fine, all right, because we get paid over here, right, with a limited loss scenario, okay, on a stock right now which has a lot of strength moving on the upwards or upside. Then we use some of those cash over here which we collected, okay, all right, and we use some of it over here to increase our profitability, right, by turning around and buying the call spread. Okay, why? Why do we do so? First, simply because, right, of this breakout signal over here, right, we can see it as a very bullish signal because it's coupled with, higher volumes over here, all right, which means from the last breakout, this time when it broke out, it was doing even higher volumes. That means there are more people participating in this breakout than the last one, right? And consecutively over here, this is actually a pretty bullish signal, right? If you ask the technicians over here, right, the only thing you might not like is, you probably search up over here and got a little bit brought down by, the sentiments of the market yesterday. Because after all, the markets did fall yesterday by the tune of, I think, close to 2%, all right, 1 point something to 2% over here for the S&P 500. Now, but if we do get some positivity returning into the markets today, right, what we're going to see is probably Dell shares continue to surge upwards, and that means it's going to bring profitability to our buy call spreads. Okay, that means premiums are going to go up over here. And at the same time, for the sell put spreads, because the stock is moving upwards, that means the risk on the sell put spread is getting lower and lower, right? So when risk gets lower, the premiums also start getting lower. Okay, now, so it benefits on both ends over here. Okay, now, so what could go wrong? Okay, what could go wrong is basically this. Okay, if you buy a call spread, okay, your loss is basically limited to the amount that you're paying up front. Okay, right? But when you now also have a put spread, okay, you are actually taking on what we call a maximum loss scenario. That means if the stock fails, that means if this breakout fails and the stock goes all the way back down, right, you could potentially lose the maximum loss of the strike prices that you have chosen over here to structure the put spreads. Okay, now everyone got that? Okay, if you do got that over here, could you just type in the comment section, I've got it, all right, or just type got it. Okay, if you have any inquiries or queries about how this works over here, right, this is also the time to put them in the comment section. Okay, all right, now, so either leave your questions in the comments with regards to this strategy, or, all right, type got it, all right, if you understand what I just explained over here. Effectively over here, what I'm trying to do is I'm trying to use other people's money, or what we call OPM over here, to take on my bet. Okay, right? So I'm just prepared to set up what I call or pay out the maximum loss if I'm totally wrong, right? But to start things off, I'm actually using other people's money to try and make or create these profits. Okay. All right, so we have Hockley off the gun over here, right, telling us he's got it. Right, how about the others? Right, I understand. It's before dinner time. Everybody's lacking a little bit of energy right now. All right, okay. Apologies once again for shifting the time forward. All right, because I've got a scheduled clash over here for 9 p.m. today. All right, not to worry. Tomorrow we will be going back to the normal time slots of 9 p.m. on Friday evening for project options cash flow. So it's only going to be one day over here. All right. So Shiva says he got it too. All right. So Josephine, no worries. All right. Try to catch up over here. Okay. Kane got it too. Okay. Good. All right. Now, great. You understand now. So using other people's money, all right, to take on a directional bet. Okay. Now, so let me cite the example to you right now. So if we structure the order, this is how it's probably going to look like. Right. So we're going to sell, which you see -1 over here, right? The 57 point. Oh, sorry. All right. I highlighted the wrong one. We're going to sell first the put spread. So I'm going to sell, right, the 52.5, right, put option. Okay. All right. Now, so I'm going to sell this put option over here, okay, by clicking the bid price. Okay. And I'm going to turn around, right, and click the ask price, right, for the 47.50 put option. So what I've done over here, right, is I've created a put spread. Okay, a put spread that says 52.50, 47.50. Now, how much is this potentially capable of losing? All right, it's potentially capable of losing $5 at a maximum loss. Okay, right. So the maximum loss on this trade right now is going to be kept and set at $5. Okay, $5 or $500 for each combo that's going to be traded. Okay. All right, now, so if you're not clear why it's $500, then let me just educate you again. All right, options are traded in the form of contracts. So the minimum you can trade is like what you see over here, the quantity, which is 1. All right, and one option contract actually controls 100 shares. Okay, so whenever you trade options, it always has to be multiplied by hundreds over here. All right, okay, now, so $5 is the max loss. So times 1 times 100 will bring us to $500. Now, so once I've collected this premium, which should work out to somewhere around 215, okay, and then paying somewhere along the lines of 65, right? So I'm going to pocket somewhere along the lines of 150 over here. Okay, so I'm going to get someone to pay me $1.50 credit. Okay, $1.50 credit, all right, to sell this put spread over here. Now, and what I'm going to do is I'm going to take this other people's money, right, turn around and buy myself, right, a directional bet, right? And the directional bet that I'm going to buy over here, right, it's going to be a call spread, okay? Right now, so I'm going to turn around and buy the 52.50 call, right, which is right at the money right now, okay? So I'm going to buy the 52.50 call, which is slightly in the money, right? And I'm going to turn around and sell the 57.50 call option, okay? Now, so to buy, I'm going to click on the I'm going to click on the ask price to buy, right? And I'm going to click on the bid price to sell over here. So I'll probably have to pay somewhere along the lines of 265, somewhere in the middle of these two, right? And to sell, possibly no negotiation, so I have to accept 80 cents over here. So to do this trade over here, it's going to cost me 185, right? Possibly 185. Okay, right now. So as you can see over here, the broker starts to suggest that I could try to get this order done somewhere along the lines of 30 cents or possibly 35 cents based on our calculations. 150 is what we're going to get in credit, all right? And we have to pay out 185 in debit. Okay, so somewhere along the lines of $30 to $35 over here to get this bet going. Okay, now, so you can see over here, I've just structured a bet over here which has a $5 potential max profit or $500, right? And my upfront cost over here is actually just $35, right? So if you work this out over here, this trade, if we get things right, okay, if we get things right over here, we could potentially make a profit of somewhere along the lines of 465, right? 465 over here. Okay, now, and we divide this by our original cost, right? Our original cost of $35, right? You can see, right? It's going to be definitely an ROI over here that, you'll be happy with. That's 1,328%, right? Now, so if you take 465 divided by the original investment of $35, all right, you would get your 1,328% returns. Okay, all right, now, so this is how you set things up over here, where you want a directional bet, but you don't want to pay too much for it. Because if you can take a look over here, if I had just buy the call spread by itself, right, the call spread would have cost me 185, right? 185. That's how much it would cost me, all right, if I did just the call spread and I bought it, right? By adding what we call the sell put spread over here, I'm able to get someone to finance me over here, right, to finance me into the investment or the bet that I want to make. Okay, all right, so that's basically what we want to do. Now, so in terms of structural design, so this is how it's going to look. So as long as the stock stays where it is, or as long as the stock goes up, right, we can expect to make some profits over here, right? And we can expect to make a maximum profit when the stock crosses over this line by July 17th expiry. Okay. Now, but of course, if it goes down, right, we could start making losses from anywhere from 0.01 all the way to a maximum of $5 if it goes below the blue line at the bottom. Okay, now, so this is how we set this up over here. Okay, now, so I've detailed this trade over here. I'm done with the upside of the upseller option strategy. Any questions before I move on to the next part of today's segment? Okay, anybody with any questions? All right, this is the time to put them out in the comment section. All right, no one? All right, okay, now while waiting for those comments as well, I'm going to launch the second quiz over here. All right, now, so part of the second quiz over here is going to work like that. All right, now, so quiz time. So if you spotted this trade on Luckin, all right, now, and for example, you spotted Luckin when it was trading somewhere here, and you believed in the scandal back then that Luckin was overinflating the numbers, waiting for a scandal to happen, much like what we see daily right now with Wirecard. Right, and today is officially declared insolvent. All right, so how will you play this trade now? Okay, how will you play this trade? So basically on this trade, we're expecting more downside over here. All right, so how will you play this trade to get the profitability that you want out of it? Okay, when it moves down. Okay, leave it in your comments as well. Okay, so this time, all right, we should be getting some clearer views over here as compared to the last quiz. Okay, all right, so questions or your comments on how will you trade this opportunity on the Luckin example you're seeing in front of your screen right now. Okay. Anyone? Oh my. Looks like this is a very favorable time slot for most of you over here. Everybody needs some energy to get going. Okay, now, so what you can do over here is, of course, like I mentioned over here, since this is a downside play over here, the first strategy you could do is, of course, buy put options. Okay, where you have to pay. Okay, the second strategy is, of course, buy the put spreads, where you also pay. All right, so number 3 will be to sell calls. Right, so for this you get paid, right? But it's risky to do so, all right, as we mentioned, all right, because your loss is unlimited. And of course, the last one over here is sell call spread. So you get paid. Pardon for the doctor's handwriting, probably because I'm using the mouse to kind of write this out. Now, so what we're doing right now is basically going on to the total opposite. All right, so we're going to do the upseller trade over here on the downside. So how do we do this on the downside? Simply flip everything around. So we want to use other people's money. So what we do is we sell the call spreads because we think the stock is going down. So we sell the call spreads over here, and we turn around and spend those money that other people have given to us and buy the put spreads. Right now, so that's what we do over here. So selling the call spreads gets us money, right? So it brings credit into our pockets or our trading account, and then we'll turn around, pay some money over here, put out some debits over here, and take on the entire trade. Now, so we're using other people's money again. See how interesting options trading can be, right? Because whatever people have been touting about when it comes to property investing, right, all these starts becoming applicable when we take options into the stock market. Right now, so you want to create rental income? Yes, you can. You buy a stock, you sell a call option. That's called a covered call. All right, so you get yourself paid month by month while you own the stock. So similar to buying properties and generating rental income on that. Okay, now you want to use other people's money to do the investments. You can as well with the upseller strategy that I've just shown you. Now, so let's take a look at the trade that I have on my screen right now. Let me widen the screen a little bit. Easy for your eyes. Now, so if we look at what I have on the screen right now, you start to see this particular trade on the Russell 2000 index called IWM. Now, so earlier in May this year, okay, I did basically a trade that expires 15 May. So it was a trade that expires in about 30 over days time. Right, so I think we did this on 9th of April. Yes, the trade date, 9th of April over here. Right, so we structured up the trade, all right, to profit if Russell starts to turn down, and it turns down no, this was an upside trade. Why did I put it here? Was it an upside trade or a downside trade? Let me verify this first. Hang on, everyone. Oh, this is a downside trade, okay? Now, so what I did over here was I bought the put spreads, right? And I sold the call spreads. So as you can see over here, all right, I sold -1, the 130 call. Okay, and then I turn around and buy the higher strike call option, okay, 136. So that's going to lead me to this, sell 130 call, buy 136 call, all right? So it's going to give me some credit when I sell this call spread. Okay, and I'm going to turn around, take that money over here, right, and spend it on the put spreads. So I'm going to buy, as you can see, the green color line says 118 puts, right, and turn around and sell the 112 puts. Okay, now for the entire combo over here, if you offset the entire amount, it would have equated to a net credit of 59 cents. Right, so someone paid me 59 cents for this entire bet over here. Right, so see, this is actually a little bit different from the Dell trade that we've taken earlier, right? And that's also the wonderful part of the upseller option, right? So the upseller option means that you structure something, right, where you pay very little to get it started, or there are many, many times where you can actually get people, right? Get people to pay you to get started, right? So we are taking on what we call a $6 max loss with difference in the strike prices, but right, we are also getting paid almost 10% of that amount upfront to start the entire trade off. Okay, now, so this is the trade structure. So we sold the call spreads, right, and get some credits over here. Oops. There we go. Right, and then we turn around, all right, use some of those money over here, right, to buy the put spreads. Oops. Now, so if the stock goes up, then we realize a potential max loss of $6. But if it goes down, we also pack on a potential profit of $6. But there's one bonus now, because we got paid 59 cents to get started. That means our maximum profit becomes $6 plus 59 cents. All right, so we could make more than the width of the put spreads itself. That's an amazing thing over here. All right, so you can see over here we could potentially make a profit of $6.59 on nothing. Right, on nothing, right? Because we didn't pay to start, right? We didn't pay to start, right? So see why I actually love this strategy over here. Now, so this is the marvel of options, when you know exactly what you're doing and how to play around with the rights and obligations of the call options as well as the put options, and whether you're a buyer or a seller over here. Yeah, okay, right now. But do take note, this would definitely require some practice and experience before you can execute a trade like that. Okay, now, but let me highlight on this further again. This trade that I just mentioned on the IWM was actually a trade that I put out over here to, you know, one of my elite trade services over here, where, you know, we talk about different opportunities in the market. So you can see on April 9th, right, I told, right, the subscribers over here exactly the trade that we structured, right, to sell the 130, 136 call spread, right, and then to turn around and buy the 118, 112 put spreads. But, right, we did it for much lower credit. We did it for about 35 cents credit. Okay, right now. So this, right, would, you know, set up and require a deposit, right, a deposit, because there is a max loss that is capable of happening, right? So the max loss is somewhere around $600. Okay, less 59 cents of course. Okay, so it's gonna sit somewhere around $541. Okay, now, so how did it pan out? Right, just about 1 week later or so. Right, 1 week later or so, we got the drop. Right, we got the drop because our IWM was at 123. All right, as you can see over here, 123. Right, and it fell all the way to 116, right, in just 1 week, right? So 123 minus 116, that means we have IWM, which is the Russell 2000 ETF, falling by $7, right? $7 over here, right, over the span of 1 week. Now, what is driven over here is driven the put spreads premium much higher, and it has also made the call spread premiums much lower. Right now, and you realize 7 days later, I could close the entire combo structure itself, right, for a 135 credit. Now, so what's my profitability? It will be the 135 credit, which I'm getting to close everything right now, plus the 59 cents credit that was already sitting in my pockets. So that means I made about $1.49 on my deposit of $5.41. So that's a trade return of around 35.9% in 1 week. Okay, right? So this was actually a real trade that was done over here, right? And how showing you exactly how, you know, such a trade design over here could actually work out to create profitabilities over here when you apply them. Okay, all right. Now, so let me go to how do you use this strategy? Okay, any of you with comments or questions with regards to the strategy, the upseller strategy on the upside or downside, like I've just mentioned, all right, please feel free to leave them in the comments right now, okay, so I can attend to them once I'm done with this summary over here, okay? Now, so how do you use this strategy? The entire combo, right? That means the sell call spread, buy put spreads, or the other way, the sell put spreads, buy call spreads, okay? It has to be done for even or a small credit to start. Okay, now you can afford to pay a little bit for it, all right, but do not pay too much. Otherwise, you will be better off just buying whichever side you want instead. Yeah, okay, remember, the whole idea is to use other people's money, which means it will cost you very little to start. Okay, or in fact, maybe somebody pays you to get this done as well. Okay, now, second, you definitely need to have a directional bias. That means, okay, you can't expect the stock to be sitting around nowhere. you actually want the stock to move in a certain direction. Okay. Now, next, you want to structure a design, a strategy design that allows you to clock in higher ROI gains over here. Okay. Now, and lastly, over here, you want to minimize the upfront investment payments. Okay, that means you want to minimize how much you put for the trade upfront over here when you open the trade. Okay. Now, so when you feel directional, yet you are, kind of unconfident, right? But you're still very greedy. Okay, greedy for big ROIs, greedy for big profits over here, right? So you can use the upseller strategy over here as, an idea to enhance or boost the returns. Now, so what are some of the pros and cons, right? The pros, of course, is to get paid to start, or you get to pay very small amounts to get started, right? Second, right, you can still profit from non-movements over here, right? Just like our Dell example. If the stock just sits where it is, we can still, make a little bit of a profit over here, right? Now, the Russell will be the same as well, right? When we did it, somebody paid us 59 cents. So if the stock just sat where it was, we'll still make the 59 cents as well. Now, limiting loss over here if you're wrong. Okay, so our losses are always kept to the spreads that we're selling, be it whether the call side or the put side. Okay, now, cons, of course, if you're wrong, you're still going to end up losing money, right? And there's a smaller ROI. That's not right. All right, let me take that off. Let me take that off. All right, while I do that over here, I still see no questions. All right, so if you do have any questions for me regards to this strategy, all right, this is time to put them out over here. Okay, all right, so with that, I'm actually done with today's topic, all right? Now, and of course, one thing that you could want to see, right, to apply something like that on right now would probably be, perhaps the SPY, all right? The SPY is none other than the S&P 500 ETF. So if you really believe that we have more downside planned for us, you could apply the upseller downside options, right, where, you could sell the call spreads on the SPY with a capped maximum loss, and then turn around, use that money to buy a put spread on SPY to create this upseller effect over here. Okay, all right. Now, so we got some questions over here. So Kane, what indicator do you use or see to see an upside or downside sell strategies that can be taken? You would have to be versed in technical analysis, really, right? Because when you're directional, you are like buyers on the upside or buyers on the downside, right? Most of the time on a short-term basis, you have to be trained in technical indicators, right, to be able to do so, right? Just like, I elaborated and explained earlier why I'm bullish on Dell, right? That's because just by looking at the charts, we see two breakout moves, and both of these moves were with increased intensity or increased volume amounts over here. Right? Okay, now, so things like that, right, to support the judgment. All right, next one over here. Right, expert, advanced level, need time to digest. All right, okay. Now, not really an expert, not really an advanced level, but just, knowing your options well enough, knowing your strategies well enough. So, kind of mix and match. Okay, you kind of mix and match over here, right, to achieve, a better outcome than doing it outright by itself. Yeah, okay. Right, no, it's different. It's different, right? It's not a butterfly over here, right? A butterfly strategy will be something like that. Okay, now, so a butterfly strategy would be something like that, right? Where, where do you go? Right, where, it is all calls, okay, or all puts. Okay, right, where else now we're actually selling a put spread and buying a call spread, or the other way around. Okay, whereas a butterfly is using only one specific type of options. Okay, so it's different. Okay. All right, Anthony. All right, let's have a look. What's the best time range over here for an upseller strategy? Okay, whatever time that you deem is suitable, right, for the move in the stock to happen. Right, so it can be 2 weeks if you believe that it's going to burst out of the gate, or it could be as long as 1 month or even 2 months over here. Yeah. Okay. So it all depends on your view of the timeline for the move to happen. Right, question, Maureen. Okay, can the spread on the put side and the call side be different? All right, for example, can I sell a $5 call but buy a $4 put? Right, why would you want to do that, Maureen? All right, why would you want to do that? Because what you're doing right now is you're taking on a $5 risk, but only for a $4 potential profit. Right, you see how it doesn't weigh out now, right? Because you're risking $5 when you're wrong, right? But your maximum profit is only $4. Yeah, okay. You might have the idea that maybe if I, buy a $4 put spread, I may get a credit to start, right? That's why I'm thinking of your intention over here. Okay, but at the meantime as well, you're limiting $1 from your profit level. Okay, right? So I wouldn't do that. I'll probably keep the risk and the reward, at least balanced over here. All right. The other way around, which means you're trying to sell for a smaller risk but a bigger profit, then you'll probably have to fork out more upfront. That means the debit amount to start, right, would be maybe more expensive. Okay, now let me go back to the Dell example, maybe to use the example a little bit and highlight it. Okay, now, so you realize for Dell, we don't really have a choice because the strike prices move in 2 to 50 intervals. Okay, so let's say if you do what you are suggesting, right, you want to make it smaller. So let's say you sell the put spreads, so you lower the risk. So you sell a 250 put spread, 52, 50, 50, so you get about 215, and you pay about 120. Right, so you realize when you offset these amounts, you're only going to pocket 95 cents. Right, 95 cents. Whereas on this side, you still have to pay your 52.50, 57.50. If I didn't remember wrongly, it's 185. Right, so ultimately over here, you're still going to end up paying something along the lines of 90 cents. All right, which is going to make it costly to start off over here. Yeah. Right, welcome. All right, great. Oh, can't see my screen. Sorry. Let me share it out again. Yep, this was what I'm trying to show you over here. All right, pardon me for that. Okay, now, so I was saying over here, if you're trying to make your put spreads a little bit smaller, all right, so you're probably going to choose this, right? And selling 52.50 gets you 215, paying 120 to buy the 50 puts means you only get 95 cents credit, but your debit is going to be 185. So you're still going to pay a 90-cent debit to structure the trade. So it becomes $90 to start, right, with a $500 max profit. Right, so you see how it becomes costly, right? So if you're at 90 cents, then you might as well just, double that amount and just take an outright play by itself. Yeah, all right. Okay, Maureen, I hope you got that over here. Okay, any questions? Any further questions? Welcome. All right, now, so it seems like that's all the questions we have for today's session as well. So once again, please accept my apologies in advance for bringing the time forward over here on such a short notice. I still want to make sure that I get the session going for the benefit of those who can still join us on the amended timing. But tomorrow we are on day 26. And I'm going to discuss another option booster strategy over here, right? So tomorrow I'm going to talk about how you can be the shrewd, right? The shrewd casino operator. So we're talking about how you can sell put options on a portfolio basis over here, right? But selling put options often cap our ROI. That means we can only make how much we collect upfront. But if you want to be an option seller or put seller over here, but still be able to generate all those 100, 200, 300% returns if you're right and the stock goes up, right? Tomorrow, I'm going to show you a strategy which can allow you to do that, okay? So do stay tuned with us again for tomorrow, day 26. all right, which is also going to bring, almost to an end of our entire month of June project options cash flow as well. Now, we're going to have 2 last sessions after that on Monday and Tuesday, which is the 29th and 30th of June. Okay, now, so thank you very much for those of you who managed and spent some time and set aside time to join us today in today's session. All right, if you have not done so, do click the share button over here, just for the sake of our fellow graduates as well, who probably missed out on the amended timing over here. Right, and for the rest, see you back on our normal time at 9 p.m. tomorrow evening. Same time, same place over here. All right. Thank you very much. Good evening and good night, everyone. Bye-bye. Have a great dinner. Bye-bye. Bye, everyone.